Hi there. This is Lee Thurburn again, and we're relaunching the live stream for Tuesday, March 9th. I just launched it a minute ago, and I got a notification through our streaming channel technology that it wasn't being picked up by LinkedIn, and of course, we want to make sure that LinkedIn gets the stream. So before I really get into it, I'm just going to start over again and ask that you go to livestreamlee.com and join our community. Click on the Join Our Community link, and that'll give you access to got a lot of activity going on here today. That'll get you access to our community area where the documents that I'm going to be sharing here shortly regarding the SWOT micro strategy analysis will be available to you. But before I get into that, I want to talk about a subject that is near and dear to the hearts of everybody in the world of business. And it looks like I'm having the same issue again. So I'm just going to go ahead and continue, and then hopefully this will get picked up by LinkedIn a little bit later. Let's see here. Privacy schedule later, save changes. I don't know if this is streaming to LinkedIn or not. Looks like I have an alert. So let's try this. I'm going to remove LinkedIn and just remove. And I'm going to try to add LinkedIn back. We'll see if this works. This is first time this has happened to me, so I apologize for the inconvenience. This is, after all, live streaming, so stuff can happen. So what I want to talk about again is the concept of money supply, and I am not directly talking about the supply of money into your bank account. I'm talking about the concept of stimulus money. So I'm going to jump out of this slide, and I'm going to jump into a slide that I have prepared for you to talk about money. So back in 2000, I bought a couple of different Quiznos franchises. And at that point in time, an Italian classic sub sandwich at Quiznos was $1.99. Today, an Italian classic sub sandwich on Quiznos is $6.37. I'm still having issues with my stream, so I apologize for that. I'm actually looking at something here. Let's try this. We're going to try this. See if this will stream. We're trying to stream now to our Facebook business page as opposed to our primary page. Whoop, that's not approved for link online. It's only available for a limited number of groups. Okay. Well, we're going to remove that. So I'm just streaming to Twitter, Facebook, and YouTube at this point. All right. So I'm now, I'm just going to kind of do a reset here on my mind. Back in 2000, a Quiznos Italian classic sub sandwich was $1.99. Today, an Italian classic sub sandwich runs about $6.37 here in most of the North Texas market. Could vary a little bit. But if you use those $2 amounts, that's a 320% increase in the price of the sandwich. And of course, the sandwich is still effectively the same sandwich today as the one you could have gotten 20, 21 years ago. So what do you get for your additional $6 or $4.37 or so? Well, the answer is you don't get anything. You get the exact same sandwich that you would have gotten back then. Of course, it's not 21 years old, but you get the idea. So effectively, with a 320% increase in the price, basically due to inflation, that is really not so much inflation. I mean, when you think of inflation, it doesn't really put it into context. What it does mean is that your dollar is really only worth about 31 cents compared to what it could buy back in in 2000. By that I mean today you need over three times as much dollars to buy the exact same thing that you could have bought with a dollar back in 2000. That's a result of inflation. That's a result of our federal government manipulating the monetary supply to bail us out of all of the calamities that have happened. And this started with, really basically started with 9/11. And then the housing bubble, we pumped so much money into the market to re-stimulate the economy after 9/11. Then we had the savings and loans crisis in the late 80s, or the late 2000s, 2007 through about 2010. And at that point in time, we built out a whole bunch of savings and loans, and we built out financial institutions, poured a lot of money into the money supply. We kept the money supply very liquid all the way through the Obama era, and really haven't seen much change through the Trump era. But what you have seen now in 2000 and 2021, 2020 and 2021, is tremendous amount of money being poured in for the stimulus. And we're basically dumping tons of money into the market. So what is that impact having? Well, that money is going to cause inflation. So a sub sandwich costs you over 3 times as much 20 years later as it did 20 years ago. What about a house? The average home in the United States has gone from, and I have Texas home, but it's actually market data for the entire United States. The average home in the United States back in 2000 was about $132,000. Now the average home in the United States is approaching $305,000. That's a 230% increase, which means that what you used to be able to buy for 47 cents, you now have to spend $1 for. Or to put it differently, what you used to be able to buy for $1, you now have to spend $2.30 for. So when you own a home, there's a lot of people will tell you that a home is a great hedge against inflation. Well, really all that really means is that if you have a home and you got it paid off, it's going to go up in price, probably close to what inflation will go up. Now, this is a very real thing, and it has very real impact on your business as well as on your personal economy. I'm going to show you one other interesting data point. Back in February of 2020, the US dollar was worth 86, almost 87 euro cents, 0.87. So $1 would get you 0.8672 euro. Today, you'll get 0.80467 euro. Now that's an exchange rate thing, and that's kind of a complicated thing to understand, but basically it just means that you get less euro. The euro has become more expensive, and that means that everything we buy from Europe is more expensive. But it's not just Europe. It's everywhere in the world. The dollar is going down in value, and that has a couple of major ramifications. First of all, it's important to note we've seen a 7%, over 7% decline in the value of the dollar in just the last year. And that is that's primarily due to the 2020 COVID stimulus package. That's the primary thing that's happened since February of last year to now, is we've dumped a couple of $1 trillion into the U.S. economy. Well, we're about to dump another couple of $1 trillion into the U.S. economy. You know, $1 trillion here, $1 trillion there, pretty soon it's real money, right? So it's important for us to realize that if you see a 7% devaluation of the dollar in just 1 year, it's likely that with an additional $2 trillion, you're going to see in excess of 7% devaluation of the dollar in the next year. Probably over the next couple of years, just on that alone, you'll probably see a 10 to 15% devaluation of the dollar. Now, You look at what has already happened, you're talking about really something close to 20, maybe 22%, could be as high as 25% devaluation of the dollar in a 2 to 3 year time frame, starting about a year ago and running a couple of years into the future. 20 to 25% devaluation of the dollar. Can you imagine what that is? I mean, that is an incredible inflationary impact. Now, you may not realize that here inside the United States because we're kind of cushioned. But the fact is, things are going to start costing more, and you're going to start having to pay more, both for the supplies or materials that you use, the labor that you use for your business. You need to start thinking right now about how are you going to adjust your pricing policies and practices for this this event that is happening to us right now. So now that's what I wanted to cover on this particular sort of lead-in. I'm going to leave you with a graphic. This is actually a picture from Germany in 1923. And what you're looking at are people carrying wagon loads of Deutschmarks down the street to the bank to try to cash them in and get something of value. Literally, paper money became worthless. That's exactly why you're seeing cryptocurrencies skyrocket through the roof. So the moral of this story is be prepared for incredible cost increases, because people are going to have to start adjusting what they charge you for their materials and supplies and labor, just like you're going to have to start making adjustments too. We're about to enter a period of rapid inflation. You can listen to any politician tell you a story otherwise, but I mean, I tried to give you 3 different points over the last 20 years of how our dollar has gone down in value. Your home cost you 2.5 times almost now what it did 20 years ago. Your sub sandwiches cost you 3 times what they did a year ago. And just in the last year, exchange rates have caused the US dollar to devalue by over 7%. Be aware. So now that I've spent 15 minutes of my 30 minutes trying to adjust my stream and also trying to share some information with you that I think you need to think about, I'm going to now talk about SWOT analysis. And to do that, I'm going to actually share a screen that I have prepared, and I just have to pop this application window open. And hopefully I'm going to pop back over here and just make sure that what I'm seeing is what I think I'm seeing. Actually, let me close that slide because it's floating on top. Okay, so what I'm sharing with you now is a screen that shows you a traditional SWOT analysis. And so here in this traditional SWOT analysis, we're actually doing a SWOT analysis here of the Boston Beer Company. That's Samuel Adams. And a traditional SWOT analysis will have a grid with 4 boxes where you talk about your strengths, weaknesses, your opportunities, and your threats. There's another way to do this, but first let's look at this. Now, this is an analysis of Samuel Adams Beer, Boston Beer Company, done in early 2019. And so their strengths were a lot of really powerful strengths. They had a strong dealer community, great relationships with dealers, a strong distribution network, which is important if you're distributing something physically large and heavy like beer. They have strong customer loyalty. They had over 300 people in their sales force out there helping to nurture their dealer community and their distribution network. They had over 300 salespeople, very educated. They had a strong quality reputation, had been earning awards in the beer community for quite a while. They have a strong history of innovation. They actually have a division of their company devoted to coming up with innovative new products. And they have access to capital markets because they're a publicly traded company. Now, at this point in time, back in early 2019, their stock was selling for roughly in the mid 300s, $340, $350 a share. Now, let's talk about weaknesses. They actually, as a beer company, in the grand scheme of things, only have about a 1% market share. The big ones, Anheuser-Busch, InBev, and Heineken and others have much bigger market shares. But so their weakness is a relatively small footprint. They own their breweries, which means they have large capital investments, and certain of their products are dependent upon foreign supply sources. When you look at the opportunities that they have, a couple of them really jump out, and that is they're good at developing new products, and there's demand for new products, and there's a lot of opportunities for acquisition. There's a tremendous number of craft beer companies, craft brewers around the United States. Boston Beer Company has not yet made much of an international foray, so they're still primarily a U.S. Located beer company. I think they have some distribution in Canada. And from an opportunity perspective, they have acquisitions and a lot of demand for new products outside of the beer market. And from a threats perspective, the big shipping brewers, those are the big ones I mentioned, there's a lot of competition there. Craft brewers are continuing to pop up because they're relatively inexpensive to get started, and customer preferences are shifting. People are beginning to be a little bit less beer-centric and a little bit more in what you might think of as malt alternatives, hard cider and stuff like that. So as well as traditional spirits as well. So these are the SWOT analysis, and this is sort of a traditional layout, but there's another way that you can do that. And you can actually use the SWOT grid to do a matching of your strengths with your opportunities, your weaknesses with your opportunities, strengths with threats, and weaknesses with threats. And so I thought I would just spend a moment and show you this for a couple of different companies that recently done an analysis for. Now, this is actually based on case studies that I've done for our class. Our class have done. I teach strategy at UT Arlington. And so this is where the data is being pulled from. So when you look at the strengths and the opportunities, obviously the opportunities alone, new product opportunities, demand for new products and acquisitions, there's lots of brewers out there. This means that you could really leverage pretty much all of these strengths to launch new products into your dealer and distribution network, leverage your customer loyalty by inviting them to try the new product. You already have a reputation for high quality products and having innovative products. So there's a lot of matching between your strengths and the opportunities that are out there in the market. One of the weaknesses that Boston Beer has is they have a small market share. And you can combine that with the opportunity for acquisition to increase your market share. So a weakness of a small market share gives, and matched with an opportunity of acquisitions, and you couple with a strength of strong, basically access to capital markets, which I don't think I transferred down to this one. So they acquired Dog's Head Brewery, which was a big acquisition for them. When you look at their strengths relative to the threats, the threat that they have is that customer preferences are shifting. There is a decline in the millennial interest in beer. Millennials are more interested in things like wine and coolers and hard ciders and that kind of stuff. So use your strength in the innovation area and your customer loyalty, and go ahead and develop some new products that both are an opportunity as well as eliminates a threat. So if you do that, then you've matched, again, you've kind of matched your opportunities and your strengths and your threats all together to come up with a micro strategy. Again, looking at a weakness, which is that you have a weak market share and you have shifting customer preferences, launching new products to try to expand your market share and satisfy customer demands and shifting preferences is a way for you to match a weakness and a threat with again, a micro strategy. So you can see that they're using a SWOT grid matching process can help you to identify some micro strategies. Now, I want you to take note of the fact that and this is amazing, since the beginning of 2019, which now we're talking about just 2 years, Boston Beer Company has grown from a market cap of about 4.5 billion and a share price in the mid 300s to a share price of close to $1,100 and a market cap of 12.5 billion. And that's in about an 18-month time frame. That's a massive growth. And you know why that happened? Because they acquired Dog's Head Brewery and they launched hard cider options. And so they did exactly the thing that the strategy says that they should do. So the concept of looking at a matching SWOT grid for matching strengths and weaknesses with opportunities and threats to come up with micro strategies actually was the kind of thing that helped Boston Beer Company triple their market cap value in as little as 18 months. That's a pretty massive growth. Another quick example here is a company called Fresh Direct. They're in the online grocery business. They're based in the Bronx in New York. Their strengths are and they've been in business since 2001. I'm going to super go through this fast because I just kind of want to hit the high points, but they have strong brand recognition. They have a state-of-the-art production facility. They have learned how to leverage their production facility with the efficiencies that they need. Their strategy is basically to improve quality and lower price. So to have a lower price and a higher quality experience for their customer using an online grocery shopping process. They have great supplier relationships and they have plenty of capital. They started out with about 100 million and got another 200 million in capital from JP Morgan recently. And that was basically primarily to help them look at and start a national expansion, which they have not yet done. They are still primarily in the Philadelphia and New York City areas, the big New York, the northeastern, highly dense markets. Weaknesses, they've had some software glitches, they had high management turnover, they had delivery logistics problems, and those resulted in consumer trust issues. From an opportunity perspective, they have the ability to expand outside of the northeastern large city quadrant. You have consumer trends, preference trends are changing. Consumers are becoming much more interested in the convenience of online shopping. You also have two other things. Mass transit and significant suburban density is beginning to come together. You think in the Dallas market about how you have the spoke lines, rail lines coming into downtown Dallas from the suburbs, and along those lines you have highly dense residential communities and a lot of people that no longer really have or feel like they need cars. So that's your prime audience, people that don't really have transportation. Now the threats are that they have environmental issues. They use a tremendous amount of cardboard packaging and plastic packaging in their particular delivery and shipping methodology. They also have exhaust emissions and traffic congestion issues with their delivery methods. They need to work these things out. Suburban consumers outside of the highly dense metropolitan areas are still interested in driving their car and doing their own shopping. But with COVID, of course, that's probably changed significantly. There's an intense amount of competition because this is a highly lucrative, higher margin version of the shopping, the grocery shopping, because you're able to eliminate a significant amount of intermediary costs or disintermediated costs in the supply chain and the value chain. And you also have a lot of competitive dynamics in the sense that bricks and mortar grocery retailers can respond to an online presence by a variety of different online options that they have. So when you start matching, you really look at the opportunities being that they can expand outside of their corridor, the northeastern corridor, because there's a lot of density occurring in areas like Dallas, which would make Dallas a nice target. Atlanta and other communities are seeing similar kinds of urban density and mass transit infrastructures develop. They can focus on the convenience and the cleanliness of their facilities and focus on the convenience of the shipping purchasing options. So, convenience-focused marketing to focus on the changing dynamics in the marketplace can help them. By focusing on one of their weaknesses and matching it with the opportunity of consumer preferences are in fact changing towards an online preference, and the convenience factor, they can improve their logistics issues and their software glitches, remove them, and so that gives them an opportunity to invent a better user experience. From a threat perspective, again, they have environmental issues, they have consumer preferences in the suburban community, intense competition. They can focus on marketing their convenience and freshness. They actually have a bigger selection of fresh items than any supermarket does, because they are able to focus an 800,000 square foot facility on on freshness. I've kind of had to run through this a little quick because I'm running out of time, but hopefully you've gotten a bit of an idea on how you can use a SWOT analysis to specifically look at strengths and opportunities, weaknesses and threats, and match them up and figure micro strategies out to help your company. Unfortunately, Fresh Direct is a private company, so I don't have any metrics on how they're doing in terms of executing. But the concept of using a SWOT analysis with a matching grid and specifically looking at matching the strengths and opportunities, threats and weaknesses, and so on, gives you some very specific micro strategies that you can employ in your business. I hope that has helped you get an idea of what you can do with, I'm going to remove that, what you can do with a SWOT analysis to get a more vibrant understanding and feel of how your business can compete, especially in a market where you have more sophisticated, larger businesses or better entrenched businesses. We're out of time, so I do want to go ahead again and invite you to join our community by going to livestreamlead.com, click on the Join My Community link, and I'll see you next time. Thank you for tuning in, and I'm going to see what I can do to figure out what happened with our LinkedIn stream. Thank you for joining. Bye.